Good evening, everyone. Time for another silver update. This is the weekly chart of gold provided by netdania.com. Now, you can see that the trend line is still intact, a long-term trend line. We're coming up to touching that at about 1222. You can draw it in various ways. The MACD is oversold, reaching the 100 point. That was the high point that we hit. So a very dramatic correction in the price of gold. Now, of course, all of the gold bashers have been out in full force in the media telling people that the bull market in gold is over. I don't think so. I don't think anything has really changed. But our next level to test, if we're going to go down there, is going to be down around 1,000. We could get there, but I highly doubt it. Now, with silver, we are falling back from the smackdown that came with the unemployment number. Of course, the smackdowns that occur on that unemployment number date are always predictable. Usually the consistent smackdown times are when Bernanke opens his mouth and when they release that Friday unemployment report. So that's consistent. That's what we saw. Of course, the report was horrific. It basically indicated that there's a lot more jobs because people are working more part-time jobs. The vast majority of jobs were in services industry, specifically hospitality, and I'm sure that the impact of Obamacare is being felt there as a lot of employers are shedding full-time workers and reducing them to part-time workers, at least enough to get below the cap to escape from the regulations of Obamacare. So I'm sure those are all factors. Now, looking at the chart, I just want to address one of the questions. This has to be the most frequent question I get. Why do you look at the chart? Well, of course, the reason why I look at the chart is because this is the spot price, and this spot price is used as a price gauge by the silver sellers such as APMEX, and here's compare silver prices. We're going to look at those in a bit. Now, another really important reason is to see what they're doing. So let me give you an analogy. Most of you would probably agree with me that what is on TV and what passes for news is nothing but a bunch of nonsense, lies, and propaganda. Nevertheless, I think a lot of you probably watch it, even though you are highly skeptical of it and don't believe it. And I would ask you the question, why are you looking at it? Well, the answer is going to be to see what they're doing, to see what they're saying. So that's exactly what looking at this chart is to see what they're doing in the paper price, to see what they're saying about where silver should be. Now, silver isn't here. The price of silver isn't here. Now, I can show you, if we go over to compare silver prices, the green column, of course, those are the best prices. We can see that silver eagles are trading at 20% above spot. And the junk silver bags are at about 20% over spot as well. So both of these are trading at 20% over spot. Now, a lot of people will criticize that and say, yes, that's true, but that's just dealers holding back their inventory because of the price decline, and they're just trying to make up that loss that they're going to have to take. Of course, that's not the case because they're hedged, so it doesn't really matter to them. But let me prove that to you. One of the questions and challenges I always get is, well, that's true, but what's the buy price? So if there really were a shortage or a premium issue, something like that, then we'd see that in the buy price. Well, we can see that in the buy price. Let's look over here at APMEX. These are the 90% silver bags ready to ship. You can see they've got about 5 of those for the $1,000 face. Now you know that there's 715 ounces, and you can see here that APMEX is buying them for $15,000. So you do the quick math, and that comes to about 20 $2. Let's do that real quick just in case I have that wrong. It is $15,000 divided by 715 ounces. 21, I'm sorry. So we're talking $21 an ounce. That is going to be on the chart. That's up in here. Okay. So this is where APMEX is buying silver. They're selling junk silver up here even higher, but they're buying it here. So if you're challenging the idea that there is a problem in the silver market and they're holding back inventory and that's the only reason why premiums are what they are, then you have to explain why they're buying at $21, which is a full $2 above spot. So I think that pretty much lays that to rest. Now let's go over and look at the main story here. Before we do that, I want to jump over to the interest rates. This is the CBOE interest rate on the 10-year note. Now on Friday, this had a move of 8.56%. That's not an 8.56% move in the price of the bonds, which was a smaller percentage move, but that's an 8.56 percentage change in the rate on the 10-year note. You can see here that back in May, only just back in May, the 10-year note was around 1.6%, and you can see it's now at 2.71%, a full percentage point. I guess 100 basis points, as they term that. An enormous move. And so I hope all of you did what I did and refinanced at the beginning of the year or sometime in here, because the mortgage rates are going to be going through the roof. So it appears that with Bernanke's announcement about tapering, even though they did a backing up off of that and they backpedaled seriously in the days following as the bond market tanked, you can see that the bond market continues to tank. My best guesstimate as to why that is the case is that there, I won't say bond vigilantes out there, but there are a lot of bond players, private bond players, and I think they're getting nervous. If you watch the latest Max Kaiser, you can see where they're talking about the tweets from PIMCO's Bill Gross, and he's making analogies about the Titanic and talking about how the band's still playing. So that's some scary stuff. It looks like we may be at the beginning of a secular bear market in the bonds, and that's going to have a lot of implications for what's going to happen to prices of stocks and precious metals. Now remember, in the 1970s, interest rates were rising pretty much continuously along with precious metals. So if someone tells you that if interest rates go up, then precious metals are going to go down, that's not the case. Normally, when interest rates begin a secular rising cycle, the precious metals go along with them. So, but let's get over to this story by Jeff Nielsen, and this is about the fraud on the LME. Now, it's talking about this 100-day delivery delay, and I'm going to read a little bit of this and then go into it in a little bit more detail. Jeff writes, as the rampant criminality in bullion markets becomes more and more apparent even to outside observers, we get another anecdote from the corporate media illustrating the level of fraud/manipulation in unequivocal terms. We're told that bullion buyers in London must now wait more than 100 days to take delivery of the bullion for which they have already paid. The comedic drones at Bloomberg and officials of the London Metal Exchange itself would have us believe this is due to warehouse queues, while precious metal bulls undoubtedly appreciate the imagery implied of a 100-day lineup of armored cars waiting to load their bullion in the middle of this bear market. The implication is fallacious. Now he goes on, I encourage you to read this, but I wanted to dig deeper into this because it's not what it appears. So let's go over to this story. This is from Bloomberg. LME seeks to shorten 100-day withdrawal times at warehouses. The London Metal Exchange, the world's biggest metals marketplace, is seeking to speed up withdrawals from stockpiles in warehouses where waiting times exceed 100 calendar days. Those warehouses would have to deliver out more metal than they take in based on a formula, the LME said in a statement today. Market participants are being consulted until September 30th, the exchange said. Its board is expected to review the plan in October, and the proposal would take effect April 1st if approved, the statement showed. And the story goes on. It lists, of course, Goldman Sachs is the one who operates the warehouse in Detroit. There's warehouses all over. But the main point about this is that the LME is actually the base metals market. And so it's interesting that Jeff is saying that this is affecting bullion. I don't know if that's the case or not, but in the process of investigating this, some strange things appeared. So let's look at the Wikipedia about the LME, the London Metal Exchange. The London Metal Exchange is the futures exchange with the world's largest market in options and futures contracts on base and other metals, as the LME offers contracts with daily expiry of up to 3 months from trade date, along with other longer dated contracts. It offers hedging, worldwide reference pricing, and option of physical delivery to settle contracts. In July 2012, LME shareholders voted to sell the exchange to Hong Kong Exchanges and Clearing for $1.4 billion. It's located in the City of London. Now, I can't think of a more typical example of the direction that things are heading to see that London, the City of London, is selling its metals exchange to China. But let's go down here and look at what they talk about with the misconception about precious metals. Precious metals. Contrary to popular belief, the precious metals gold and silver are not traded on the London Metal Exchange, but on the over-the-counter market, usually referred to as the London Bullion Market, by members of the London Bullion Market Association, LBMA. Platinum and palladium are traded on the London Platinum and Palladium Market. Both members of the LBMA and LPPM trade the precious metals spot market on EBS, Electronic Broking Systems, acquired by ICAP in June 2006. Many companies involved in minor metals are members of the Minor Metal Trade Association. The LME does, however, provide trade matching and clearing services to the London bullion market that distributes gold and silver and gold interest rate swaps, forward rates on behalf of the LBMA. So that may be what we're talking about here. That may indicate that Jeff is correct. I really don't know the answer. Someone needs to do more research on this. But it does appear that there is a connection between the LME and the LBMA for the matching and clearing services to the London bullion market for gold and silver. Now, what's really interesting about this is when we look at this story, they're talking about why there's such a delay, and they're talking about rules of having to take out of the warehouse as more than you take in, and things like that. So I decided to go and check the Kitco charts. You can go over to Kitco Metals and get the charts of the base metals. And these are something that I watch fairly closely. If you remember, many years ago, we had that near nickel default. I think that's off the charts now. If we go to nickel and look at the 5-year stockpile. Actually, it's just rolling off the chart now. You can see it was lower. It was near default levels. But what comes up that's so striking here is you can see the 5-year nickel warehouse stock levels are at all-time highs. They're higher than they were after the economic catastrophe, and they're rising. So that is a very bearish type of sentiment for the economy. Now, the thing we want to compare this to, the 5-year warehouse stocks levels, is we want to compare that to the 5-year spot price. So you can see that the spot price has fallen from its high of 13 all the way down to 6. So the spot price is falling, but the warehouse levels are at record highs. Now, that is not what you would expect to see in a normal market. You would expect, as these spot prices fall, that would cause less supply to come online because it's less profitable to do so. That's not happening. Now, the other thing to keep in mind is that why would there be any delays when these stocks are at record highs? What is the explanation for that? Now, it's not just the case in nickel. Let's take a look at zinc. And you can see here the 5-year zinc warehouse stock levels. Again, they are nearly tenfold what they were at the beginning of the financial catastrophe. The stockpiles are up nearly tenfold. And when we look at the 5-year price, we can see it's down nearly 40%. So the same thing is the case with zinc as with nickel. Let's look at copper. You can see the copper stockpiles are at record highs as well. And the copper spot price is down from about 4.5 to 3. So it's down a good 30% from its high, with warehouse levels still rising. And the last one we're going to look at here, we'll look at aluminum. And there it is again. The 5-year warehouse levels, you can see, are up 5-fold plus from where they were. And the price is down 50% from where it was. So that is a very anomalous situation. First of all, why would there be any delays when the stockpiles are higher than they have ever been in these base metals? Does it have something to do with gold and silver problems, a connection between the LME and the LBMA? I don't know. Clearly, it doesn't make sense. Now, the other big thing to think about is we know that these base metals are the same mines, for the most part, where the gold and silver are mined. So are they mining the gold and silver at a loss and just ending up with more than economical amounts of these base metals, and that's causing the base metal prices to collapse? Are we in the midst of some kind of depression? It certainly would appear to be the case from the stock levels that are at all-time highs. So a lot of questions, very, very few answers. We know that the markets are rigged. We know that the silver market is rigged. We know that the gold market is rigged. It appears that the base metals markets are rigged. These all seem to have something to do with each other. They're all connected. And it's very interesting that we saw that the LME was sold to the Chinese, and the power seems to be moving from the City of London over to China, and we're just not seeing real markets at this point. Will there be real markets when the exchanges begin to open up in China and the trading begins there? I don't know. Your guess is as good as mine. We'll have to wait and see, and we'll talk to you next time.